Hello, today we're going to be starting chapter 3. And in chapter 3, we're talking about the double entry framework. And as we go through chapter 3, I think you'll realize that a lot of things that we learned in chapter 2 is being applied to chapter 3, and it just goes from one point to another. The first thing that we're going to talk about in chapter 3 is what we call a T accounts. In accounting, the T accounts is one of the most essential things we have. And the main reason it is so essential and why we use it is because it helps us separate our accounts. It helps us to know whether we're increasing accounts, decreasing accounts, things like that. When you look at this, we call it a T account because it's shaped like a T. On one side of the T account is a debit. On the other side of the T account is a credit. Debit means left. Credit means right. Now, some people in the past have asked me, like, why did they come up with the word debit? Why did they come up with the word credit? I do not know. I've asked people, no one really knows. But in the accounting world, that's just generally how it is. The debit is on the left-hand side. The credit is on the right-hand side. There's abbreviations that you'll see a lot for debit and credit. Debit is DR, credit is CR. And yes, I know there's no R in debit, but we still use it as abbreviation of just DR. It just simplifies things for us as you're going through your accounting. So we have the T accounts for every single account. And if you remember in chapter 2, we dealt with things like cash, prepaid insurance, accounts payable, accounts receivable, supplies. We had a revenue account. You had expense account. So each one of those is going to have a T account. And the top of the T account is going to be the name. And then you have your debit and your credit. So every T account also has one side of it's going to increase and one side of it's going to decrease. It's always going to depend on the type of account you have, whether it's an asset, a liability, or owner's equity, revenue account, or an expense account. So the debit side is always on the left and the credit side is always on the right. But as we talk about it with some accounts, again, they're going to increase on the left side and some accounts will increase with the debit on the right side. When we go through a balance, what we like to do is we call what we call a footing. We want to get the final total number of it. So if I added up everything on the credit side, you would see that in cash it was $3,130. If I counted everything up on the debit side, it was $3,500. So to find the balance of it, we're going to take our debit minus our credit and says that cash has a balance of $370, which will be written on the side of the larger amount. So whichever side is the larger amount, that is what we call the balance of an account. So debit and credits, as we talked about it, you see a debit is an account. It means that it's entered any amount on the left side. A credit to an account means it is anything that's entered on the right side. Each side of them may increase or decrease depending on the balances of each of them. Okay, it's also true for debits. Again, we have to classify them as the different types of classifications of accounts as assets, liabilities, or owner's equity. And then that will help us tell us whether they increase or decrease on the debit side. So first we have assets. Now we talk about assets, we're talking about cash, prepaid insurance, anything that has value. Assets is going to increase on the debit side and decrease on the credit side. The important thing to remember here is that your normal balance is always on the debit side. So if you had cash and you want to know that you had money, you'd want to make sure you had a debit balance. We credit things and subtract things from cash that way. So all assets, whether it's insurance, whether it is supplies, accounts receivable, any of those things that are an asset to us, equipment, they're all going to increase on the debit side and decrease on the credit side. Liabilities is the opposite. And you kind of look at liabilities as being the opposite because remember, assets equals liabilities plus owner's equity. So liabilities is going to increase on the credit side and decrease on the debit side. One way that I have found that this helps students to remember is if they remember the accounting equation with assets being on the right-hand side. So that or not on the right-hand side, sorry, assets being on the left-hand side. I don't know my right from my left tonight. With assets being on the left-hand side, they're going to increase on the left-hand side of the T account, which is a debit. Liabilities is on the right side of the accounting equation, and so it's going to increase on the credit side or the right side of the T account. Capital is just like liability. Again, it's on the right side of your accounting equation, so it's going to increase on the right side and decrease on the left side. Just like the owner's equity and liability accounts are exactly the same. So your capital accounts and then your liabilities like accounts payable. The accounting equation includes an umbrella. And we started talking about things last time that talked about expenses, revenue, and drawing. And so we look at capital as owner's equity in this capital account being this big umbrella. And our essence is this owner's equity is the top. That's what we're going to end up with at the beginning. But when we look at expenses and we look at revenue and we look at drawing, we have to think about what does it do to our capital account? Well, if we have revenue, so if we sell something or we get service fees or anything like that, revenue increases capital, correct? So if we have revenue, we're increasing the amount of money that we have in the business, we're increasing our capital. So because of that, revenue is just like our owner's equities account. It will increase on the debit, decrease on the credit. It will increase on the credit and decrease on the debit. Backwards, because capital and owner's equity increases on the credit side. So revenue is going to run just like it. Expenses and drawing actually take away from owner's equity or capital. Because if we have this revenue and this money coming in and we pay our expenses, then we're decreasing the amount of revenue or capital that we have. So our expense account is actually going to increase on the debit side and decrease on the credit side. And that is because expenses decrease capital. So that is why expenses and drawing are opposite of capital on what side increases and what side decreases is because they decrease capital. Okay. So revenue increases capital is just going to be like your capital account. Expenses and drawing decrease it. So it's actually going to be more like your assets account. It's going to increase on the debit side, decrease on the credit side. So as we look at like this a little bit closer, we have our revenue account. You can see where the increase and decrease is. And then you see your expense account. This is just like your asset accounts. Remember, because it's decreasing how much you have in your capital. And here's your drawing account. It does the same thing. Along with your expense accounts. Now, here's an area for you to look at, and this is a very good chart. It's also in your book, but this is a slide. Maybe take a screenshot of it, think something like that as you're going through this chapter, especially to remember what side they increase and decrease side on and what side their normal balance is. Their normal balance is always the side that they increased on. And you always think about that with assets or with owner's equity. As it increases, that's going to be the balance. That's where money is going to be left over. If cash increases on the debit side and you have a balance at the end of the month of a positive balance, is going to be on the debit side. So with that, this is a very good thing for you to look at. Talks about the normal balances and which way they increase and decrease. So the next step that we get into is transaction analysis. And we've talked a little bit about transaction analysis where we talk about what happened, what accounts are affected, and how does this affect the accounting equation. This is just going to go a little bit more into depth because now we actually have this increase and decrease with the debits and credits. So I'm going to go through a few of these, and I don't like keeping these PowerPoints or these videos really long with the PowerPoint. So some of these I'm just going to go through a couple of them, and then you can go back through the PowerPoint. and really take your time and read through them and look at each one of them and look at their examples. So Mitchell Williams, the owner, he invested $5,000 in the business. If we identify how it's been affected, we'd say it's cash and capital. We've learned that before. That's what we know. If we look at the classifications, we know that cash is an asset, capital is owner's equity. We've known that from the last 2 chapters. So then what we're going to look at is how is the transaction entered? Well, we know it increases the asset and it increases capital. So because of that, we're going to debit cash and credit capital for that $5,000. So it looks something like this. Now you have a balance of $5,000 in your cash, in your capital. Your liabilities, owner's equity equals $5,000, and so does your assets. Everything is together. If I purchased an asset for cash, again, let's say we purchased delivery equipment. The first 2 steps we're going to know, but then we have to think about what are we doing? Well, if we purchased it for cash, that means that we are paying cash, so we're going to decrease cash. What side does cash decrease on? We know cash decreases on its credit side because it's an asset. So then we're going to credit cash the $2,000. We know that delivery equipment is also an asset, but we know we're increasing it because now we have $2,000 more dollars. We have a motor scooter for $2,000. We have more equipment, more assets. So that's what we're going to increase it. And if you'll notice that we talk about cash, where it has a beginning balance of $5,000. We take $2,000 away, so now it has a balance of $3,000. Delivery expense under assets has a debit of $2,000, so you're still $5,000. A key thing to remember is if you have 2 assets that you are using, one will increase and one will decrease. You will never have it where you have 2 assets and they both increase and decrease. And if you have an asset and a liability, one is going to increase, one is going to decrease. Sometimes you have 2 assets and a liability. Well, maybe the liability is actually going to increase and one of your assets is going to increase and one is going to decrease. That has to do with those things, but you're always going to have one and the other if that happens with the liabilities. As we look for purchasing an asset, this is a lot like the delivery equipment we just did. If you purchase an asset on account, though, you're going to use accounts payable as a liability. And as you can see, delivery equipment was increased by $1,800. So now we have $6,800. And we put 18 over here. Now we have $6,800. So as we go through, there's payments on account. There's delivery revenue earned with cash. So it talks about where you have your cash and you increase it by $2,100. And then you're going to have this revenue account, and under revenue, which is under owner's equity, you're actually going to have something called delivery fees, which was $2,100. So again, your balances equal each other. Paid rent for the month would be the same kind of thing. You would have cash being a negative here. So you're actually going to decrease cash by $1,000, and then you're going to increase your rent. Because remember, your rent is actually increasing. You want to add up all year long or all quarter long how much your rent was so you can see what your whole rent expense was for that time period. As you go through some of the rest of these, you will see, I just want you to pay some attention to some things, looking at suppliers, looking at expenses. Just really walk through this. This show is a great example of a way to do that. The last thing that I want to share with you deals with important double entry rules. There's 2 rules when we talk about double entry accounting. One is the sums of the debits must equal the sums of the credits. You have to have 2 accounts that are affected. And we know that 2 accounts are affected in every single transaction that we have. We just can't have one account. But your debits must always equal your credits in that transaction. Also, the accounting equation must remain in balance. They're going to talk a little bit about the trial balance towards the end, and periodically doing it, labeling things as assets, liabilities, and owner's equity, and those kind of things. And here's an example of the trial balance. So what I want to share with you is there's a lot of stuff going on. I hope you understand it. Make sure that if you have any questions that you give me a call or email me, or we can do a Teams chat. So I hope you guys all have a great week, and we'll talk to you later.